Good afternoon, everybody. Thank you for joining us for this webinar today. We're happy that you're here. Obviously, we'll be discussing estate planning strategies today, and I'm joined by some great panelists today. So I'm going to first introduce myself. I'm Ryan Hohensee. I'm an associate advisory services consultant with our advisory services group, and I'm joined today by Veronica Van Nest, who's our vice president and trust officer for Exeter Trust Company, as well as a senior estate planning attorney within our department. And then we have Veronica Iacovetta, who is a senior financial consultant. She helps our clients in the Southeast, and she has over a decade of experience working with clients directly, creating customized estate plans. So before we kind of jump in anything, I want to go over a couple of housekeeping items. This webinar will be recorded, so if you don't happen to have a chance to watch it live or miss part of it, it will be recorded and sent out shortly after. And finally, we did receive a number of pre-submitted questions. We'll try to tackle as many of those as we can today. However, if we don't get to yours today, we'll follow up personally after. And then we're going to be covering a lot of material today. So if during the webinar, if you have any questions, feel free to pop those into the Q&A, and we'll try to address those and follow up after. So before we kind of jump in, I wanted to kind of give us an overview of where we're going to be today. So we're going to start off with debunking estate planning and kind of remove some of the mystery around how you start that process. We're going to jump then to components of an estate plan. So we're going to talk about kind of the how we do it: wills, trusts, beneficiary docs. We're then going to jump to common strategies to consider around taxes and estates. These are going to be very kind of broad strategies you can use. And then finally, we'll leave as much time as we can for Q&A at the end. So to start, I want to pass it over to Robin to kind of talk about some of the common misconceptions around estate planning and how she typically starts these conversations.
Yes, thanks so much, Ryan. Basically, we'll get a lot of comments about estate planning during the financial planning process. And there's two very common misconceptions that come up. One of them is, I'm just too young. I don't really even have that many assets. It doesn't make sense for me to have an estate plan, or it doesn't make sense to have an estate plan now, maybe later down the road. And the other very common misconception that we hear is, oh my gosh, I hear all of these different documents thrown around, and there's a million different types of trust. I don't understand the process. I don't understand the documents. And this really sounds very complicated and super expensive. Well, that's why we're here today. We're super passionate about estate planning and how it's such an essential part of everyone's plan. So we want to take all of these complications, break it down, simplify the process, the people involved, and the actual documents. So with that introduction, let's talk for a second about what is actually an estate plan. And we're going to have a poll pop up here in a second. We would love for you to participate and see your feedback. As you're going ahead and filling out your answers, I am going to speak to one of these items. Before the seminar, when we asked for questions and feedback, we had many people speak about legacy, and that's two-part, right? You've built your assets, you've built your wealth, then you're concerned about what happens when I die, and how much is the government going to take? How much are taxes going to erode this hard-earned money, right? So that's one part of that, is the taxes. The other part is my legacy and my children. Are they going to respect and be custodians of this wealth like I was? Not to mention grandchildren and heirs down the road, other generations that aren't even here yet. How do I preserve that legacy, again, from taxes and the government and from heirs? So we'll see kind of the answers pop up here and get a little bit of feedback. So it sounds like for most of y'all, and you're really right on track, it's many things. It's that legacy is super important to you. It's the actual documents involved, and it's avoiding probate, which is a very onerous process. So now that we've talked for a minute about the what of estate planning, let's dive into the who of estate planning. And I'll have Veronica speak on that with her wealth of experience and a little bit more about who and the stages of who needs that plan.
Thanks, Robin. So as this slide indicates, any individual who has assets really needs some type of plan. What type of plan may depend on the amount of assets, the family situation, the things that the client is trying to protect against, whether they need some estate tax planning. So basically, an individual's basic estate plan is generally a will, sometimes a revocable trust, a power of attorney to handle finances, a healthcare document, which is some states it's a healthcare power of attorney, some states it's a healthcare proxy. And those are the basic documents we see everyone have. Individuals who may have more assets may need to do some more planning. So we do see a lot of different trusts, which we'll talk about later in the presentation. And those are designed specifically to save estate taxes or for a specific purpose. And we'll get into that in a little bit. The one thing that we like to look at is what stage of life are you in, and what types of documents you might need during those different stages of life. So we've kind of simplified things here, broken down into 3 different stages. So the first stage is ages 50 and under. So those are generally, that's generally the age group where you're building up wealth. So your largest asset, usually your largest 2 assets, a lot of times are your life insurance that you may have acquired to ensure that you are able to pay for a child's college education if your spouse, predeceases at an early age. You're able to pay a mortgage. So a lot of people have a decent sized life insurance policy at that age group. You also have your 401k or any other retirement assets. And those are the 2 biggest assets that we see at this age group. So the individuals will have generally a will, which will identify guardians of any minor children, executors, trustees, if there's a trust. But really the most important documents at this age group are the beneficiary designations. It's important to remember that beneficiary designations control the distribution of an account. More often than not, we see clients who don't have their beneficiary designations in order. They might have not named a contingent beneficiary. They might not have, the beneficiary designation read differently than the will, which is usually a no-no unless there's a specific reason for that. So moving on to the next age group, we still see beneficiary designations becoming an important part of the planning in this age group. But we also see a lot more tax planning. So assets are increasing in value. There might be a need to do some estate tax planning. There might be some need to do some income tax planning, to do some gifting. We'll talk about that later. And we also see clients in this age range more interested in charitable giving. They've discovered that charities that are near and dear to their hearts, and they want to start providing for them. We also see trust becoming much more of part of the distribution plan in this age group. And then as we go to ages 70 and over, gifting becomes more of a priority. There's grandparents will establish trusts for grandchildren, mostly for college education. We do see a lot of clients taking those big family trips, spending some assets on that trip to Europe, that really nice beach house that they're going to rent for the whole family to come down and spend some time. And also, we see an increase in charitable giving, whether that's through an IRA, that's through their own assets. But we do see, at all of these ages, the primary documents I discussed are important, but we do see different interests at these different ages in estate planning.
And Veronica, wouldn't you say one of the more common questions we got was, what is the biggest oversight or mistake that's made in estate planning? And the great news is it's something that is super easy to fix and doesn't cost anything. And it's the beneficiary wouldn't you say that beneficiary designations or missing a designation or a contingent is one of the more common things that you see?
Absolutely. More often than not, we see either exactly what Robin said, there's a contingent beneficiary missing, or what the estate plan says doesn't coincide with the beneficiary designation. It's important to remember that the only documents that will be controlled by your will the only assets that will be controlled by your will are assets that are in your name alone, not those under beneficiary designation. So you really need to coordinate those. And we do often see clients that need to make those changes. And as Robin said, it's super easy to do that. Just sign a new one.
Right.
Perfect. Well, thank you for that breakdown, Veronica. So we have another poll question. We wanted to kind of gauge why you guys are interested in estate planning and what your primary concerns are. So you're going to see that poll pop up.
And as that's popping up too, Veronica, I would love it if you talked for a minute about probate and what the cost of probate is, in addition to the emotional cost and weight on the loved ones that are settling your estate.
Yeah, so there's, as you can see from this poll, there's a couple of different reasons to create an estate plan. The probate cost can be somewhat high, depending on the state you live in, depending on what's involved. Most states do have, states either have a statutory probate fee that the attorneys can receive, or it's the other states have a reasonableness standard. And that reasonableness standard has, and the states who have the actual statutory fees, you're looking at between about 3 to 5% of the probate assets. So here's the polls popping up. I'll answer that too. So that's, good answer. We see that a lot of individuals agree with all of the above, which is the most correct answer there. But probate can be expensive. So what individuals choose to do is, on the front end, perhaps you prepare a revocable trust. A revocable trust, you can prepare that, transfer assets into that trust, avoid probate at the tail end. That revocable trust might be anywhere from $4,000 to $7,000, depending on your attorney, and would avoid that large expense at the end. If you have $1 million estate, a 5% of that $1 million estate is $50,000. So quite a big difference between what can be done on either end. The other issue is it does help your family. If it's much easier to just have a trust and be able to kind of move along, do the distributions in accordance with the trust agreement, instead of having to go file papers with the courts, have an executor appointed, transfer assets, do all those things after the fact. It's a much easier process to do it on the front end.
Great, thank you. I believe next we were going to break down a little bit the components of an estate plan. So we've talked a little bit about the why and the who. Now, who are the players that are involved? So there's several different teams. And as you all look at this chart, I'd like you to look at the top 3 sections as kind of a outside team, and the bottom 3 are often an inside team, meaning family members are often a trusted friend or colleague. So a financial advisor, that would be somebody like myself. Going back to what we were talking about earlier with beneficiary designations and the different who and what, I'm the quarterback and I'm looking at all of the documents. I'm maybe noticing that there's a beneficiary designation that's missing. I'm taking documents to Veronica and we're taking a look at everything and saying, oh, we actually are missing a power of attorney. We're needing this. Maybe the trust needs to be tweaked. And then we're bringing in the other players, which is the estate planning attorney that's actually going to execute documents for you. If you don't have them, they're going to come up with a package of estate documents. Maybe we just need to amend a trust or add a codicil to a will. That's the person that takes care of that. And then finally, especially if there's a trust involved, you're going to have an accountant, right? The accountant would be involved in trust tax returns if needed. Then that bottom section, I want to break that down a little bit too, because one of the more common misconceptions we also have is between the terms trustee and executor. So going back to what Veronica was just talking about with probate, executor is the person named in the will that is literally going to go and settle your estate at the probate office, okay? So in addition to that, you may or may not need a trustee. The trustee is a very important role. If you have trust, the trustee is the gatekeeper. So the trust is the legal document, and the trustee is responsible for reading that document and making sure the terms of the trust are adhered to, right? For the beneficiaries, you're looking at the assets within the trust, if the assets need to be changed based on the requirements of the trust, or the different trust stipulations, whether it be age of child or assets that can be held or not held, are those being held to? So we'll speak in a little bit about the difference between a family or friend trustee and a corporate trustee, because it is such a weighty responsibility and much, much more than just simply being an executor. Finally, power of attorney, last but certainly not least, just because it is such a huge component of an estate plan, it's very easy in many cases. Often it's free. I know the state of Georgia, where I am, you can actually download a power of attorney from the state website and fill in the blanks. So again, don't get too overwhelmed. It's so important to have something like that to take care of your affairs if you're incapacitated. So as we've talked now about the players, we'll have Veronica talk a little bit more about diving into the actual documents involved in this plan.
Yep. So these are the main components of an individual's estate plan. First, you have the last will and testament. So as you know, I mentioned earlier, the will just handles the distribution of assets that are in your name alone at your death. It's important to remember that any jointly held assets will pass by law to the joint account owner. Any IRA assets, any life insurance, anything with a beneficiary designation on it will pass to that beneficiary. I find in conversations with clients often that, we look at their assets and we have the conversation. You do understand that nothing will pass under your will because everything's either, beneficiary designation or jointly held, which we see quite often. So it's important to kind of think about that and understand how your assets are going to pass. Usually in the will, you're going to name, as Robin said, that executor. Perhaps you have a trustee. We have, different types of trusts. Some trusts can be established under a will. Other trusts would be established by separate trust documents. But that will generally be, you will be appointing guardians for any minor children, trustees of any trust for any minor children. It's a relatively simple document. I know as attorneys, we make things a lot more complicated than they need to be. But they, as I say that simply, a simple will could be, close to 20 pages just because of all the legalese we have to put in there. So the will is, the kind of the cornerstone of that estate plan. You also may have some trusts. So as I said, you can either have trusts under the will, you can have separate trust documents, and I'll talk about some of those separate trusts that can be established in a couple minutes. But in those trust documents, you would name a trustee, you would determine the terms of the trust. Different terms there's for any trust that's established, there's a different term for them. So you might have income and principal passing to a beneficiary. You might have a percentage of the trust payable to the beneficiary each year. You might have only income. You might have principal for 20 different reasons. You might have principal for only 2 reasons, like medical or education. So trusts can be as broad as you want them to be. Powers of attorney. So there's a couple of different kinds of powers of attorney. Financial powers of attorney, I think, are very important at any age, as long as you have assets. I just had a conversation with a 25-year-old the other day who was inheriting some money from a trust and establishing his own account. And I told him, you need a power of attorney. You need somebody to be able to access your finances if they need to. Otherwise, if there is nobody in that role on the financial power of attorney, then a court action is required, which can be very costly and time consuming. So the power of attorney, which, as Robin said, you might be able to get online, or you can an attorney can prepare it for probably less than $100. It's extremely important regardless of what age you are. And then there's the healthcare directives, and Robin had an interesting point on this that we have spoken about earlier on college healthcare directives. And I, being a mom whose daughter's going off to college in the fall, I think it's helpful for everybody to know.
Yes. So as everybody's coming home for holiday break, and those 18, 19-year-olds are coming home, number 1 on the to-do list is to get a healthcare power of attorney or healthcare directive. Depending on what state you're in, it's a little bit different. Again, here in Georgia, that's all part of the POA you can download. And this is why, because once somebody is 18, typically the age of majority in most states, they are an adult. Now, you might not think your child is adulting yet, but they are according to the state. So if God forbid they're hurt, they're in the infirmary, you're trying to get details on their medication, you're trying to get details from the doctor about whatever, they will not give those to you unless you have this. And what's very interesting is that in addition to a healthcare power of attorney, each university will actually have their own form. It's very, very common. I talked to a client just recently. Their child is going to Vanderbilt. You go to Vanderbilt, it's right on their website. Again, free. You just download it, fill it out, give it to the office as part of the admission paperwork. But please make that number one, because I can't tell you how many times this happens and parents are so shocked and surprised that they can no longer get all that information on their adult child.
Exactly. Yeah. And, on the health in New York, we have what's called the healthcare proxy. A lot of states do have the healthcare power of attorney, but the healthcare proxy, and we couple that with what we call a living will. And those healthcare directives, my biggest piece of advice to anybody signing those is let the person know who you're naming as that agent. There's nothing worse than a medical emergency occurring and the agent not knowing they're the agent not having discussed your wishes while you were of capacity. It's not a great spot to be. The other thing to keep in mind is a lot of states have statutes which allow for individuals in order of succession to be named as your healthcare agent if you don't have these documents in place. It might not be the person you want. So you have to keep that in mind. It may not be the person you would want to make those decisions. If you're in a second marriage and you really would like your children to make those decisions, it's important to have these documents in place so that somebody can make those decisions. And again, the final document, you've heard me say it already, and we'll probably say it many more times in this presentation, because I do think it is so important, is those beneficiary designations and making sure that they match what is in your will, or if they don't, that there's a very particular reason why they don't. For example, if you have a will or a revocable trust that establishes a trust for your children after you pass away, make sure that that beneficiary designation references that trust and doesn't just say everything to my children. The last thing you want is to have a $2 million IRA, and the intention was to put that IRA in trust and it be a source of income for your children for a period of time. And the designations say outright to my children, your children get the IRA and can do what they want with it. So again, just extremely important. And then we are also going to talk about some different trusts. So we have, as I said earlier, there's a variety of trusts that you can establish. I've mentioned already the revocable trust. So that is exactly as its name implies. It's revocable while you are alive and can be altered at any time. So as Robin mentioned earlier, you can alter that by an amendment. Sometimes we see clients do a restatement of the trust, which is basically amending the trust, but saying, yes, it's still the same trust. And that, as long as you have assets in the name of that trust when you pass away, can avoid probate. Extremely important point. More often than not, clients will execute these documents and perhaps not make the next step and not title assets in the name of the trust. That doesn't help anybody. Those assets need to be in the name of the trust. Otherwise, a probate proceeding is required. And a lot of times people are creating these trusts to avoid probate. So that's extremely important. Irrevocable trusts. So interesting, we have the word irrevocable, but in most states, most irrevocable trusts are revocable at some point if the beneficiaries all agree. But generally, these trusts are created for estate tax planning. So these are created for spouses, beneficiaries. Sometimes you see them created during a grantor's life. They might be created in a will after death. Attorneys, we love to use our little acronyms. So in irrevocable trust, you'll see SLATs, CUPERTs, GRATs, CRATs, ILETs, all kinds of things. And these are all different types of trusts that are created for specific purposes. And I won't get into all of them because they're a lot of complicated. But those are different trusts that can be created to save estate taxes. The grantor trust is an interesting trust. It's a type of irrevocable trust where there's a special power put in the document, which allows the grantor, the creator of the trust, to pay the income taxes every year. So if you create an irrevocable trust, that irrevocable trust is a tax-paying entity. For those who may not know, irrevocable trusts, any type of trust, is the tax rates are very compressed. So for an individual to get to the highest income tax bracket, they would have over probably $500,000 in income. For a trust to get to that tax bracket, it's closer to 13 to 14,000. So for a grantor to pay those taxes is a nice benefit to the trust. The trust is not being reduced by payment of those taxes, and the grantor is making a gift without making a gift. There's no gift tax implications. It's not counted against any of the lifetime gifting that we'll be talking about a little bit later. So it's a nice vehicle to allow, if the grantor is able to do so, it's a great vehicle to let the trust grow. And then we also see minor children trusts. So we see trusts for children for college expenses. A lot of times grandparents will establish these, and they will allow for distributions until a certain age, and then graduate distributions, usually 25, 30, 35, or up to 40 sometimes. So we'll see these a lot as well.
Well, and just to speak real quick to these excellent points, going back to the team that's involved with the estate plan, that's why you have an advisor, an attorney, and an accountant, because the whole group is working together to say, how do we reduce taxes the most and which vehicles do we use? Don't get overwhelmed with the million types of trust. There are a million, but it's great because they can be customized exactly to what you need. And that's your attorney's job, is to do that work for you and figure out which one. And then the financial advisor, and this is one thing that Ryan and I do quite a bit as part of our practice, is we're getting copies of your estate planning document and saying, hey, I see you want everything going to a trust, but your IRA has a different beneficiary. And I see you spent thousands of dollars, getting a special kind of trust set up, but you don't have any assets here set up in trust. Is there something outside? And that's when we find out what Veronica mentioned is another common mistake. You've done this wonderful job with the estate planning attorney. Often they have a cover page that says, actually do this, put these assets in this type of trust. But we're here to back that up and say, okay, here's the paperwork. I'm going to change your investment asset here to this trust. We're going to change the beneficiary of your IRA, make sure everything is working in concert.
Absolutely. And I think now Ryan and Robin, we're going to talk about some different assets we use to fund trust.
Yeah, as we just kind of touched on, the most important part about trust is once you've established them, you actually need to transfer assets and fund them. And so there's kind of common and not so common things that we see to fund trusts. We get a lot of questions around that, and there's a lot of confusion. And so some of the common ways you can fund a trust are personal property, any bank accounts, cash accounts you may have, as well as any investment accounts can fund a trust. Some of the not so common ways are life insurance. Those are like ILET trusts. And then you can also do real estate, closely held business interests, and you can also name a trust as a beneficiary for your IRA. Now, Robin, I know you've had several rather unique funding situations. Could you talk a little bit to those?
Yeah, it's been really fascinating what you can put in trust, because you can put almost anything in trust. And one of my favorite examples, and this was really interesting as well as just fantastic estate planning, is a shopping center, basically a grocery anchored shopping center that had been in the family, in the patriarch's name for quite a while. He had built it, had appreciated in value, and also threw off a significant amount of income. So he put it in trust for his 3 siblings. Well, he passed away, and in the meanwhile, one of his other siblings had passed away. So at this point, you have this very specialized asset, but the trust and the trustee are covering this for all the beneficiaries. So at this point, we actually had 6 beneficiaries. A few were the siblings from one generation. Then we've got the nieces and nephews from the deceased sibling. Well, nobody had to sell the property and divide the assets up among all these beneficiaries. This incredible asset could stay in the legacy of the family. All of the beneficiaries were getting income. The trustee was the one person instead of 6 people working out the bills on the shopping center. The building needs to be repainted. The roof, needs to be repaired. Well, the trustee, right, is responsible for that. There's extra income from the trust, a few other investments we had in there that paid those bills. So it made it so much more manageable. It saved money in taxes, and it kept this very special asset within the family for generations to come.
Perfect. Thank you so much for that. Now I want to pass it over to Veronica to talk about kind of some client examples that we laid out and how estate planning can work for them.
Sure. One thing I did want to mention, Ryan, before I move on to this is we did get a question on real estate. And so I just wanted to touch quickly on that, on funding on using real estate to fund a trust. That is very simple to do. It is generally a deed that the grantor, so the owner of the property, would transfer the property to the ownership of the trust. It's a new deed package prepared by an attorney. You pay some filing fees, you pay some prep fees, and the property is transferred into the trust. The trust then becomes the legal owner of the property. Likewise, a similar question was asked as to how we get assets out of the trust. And that is, again, a simple deed. So it's very easy to transfer assets in and out of the trust, depending on what you need, even different accounts. If you need to transfer your brokerage account, your investment account into the trust name, it can easily be transferred in and out. So we're going to turn to this example. So this is a client who has a net worth of approximately $5 million, 3 children and 6 grandchildren. Their concerns are their daughter's ability to manage the inheritance. Their son, his spouse not acting as trustee of any assets that might be left to the grandchildren if the son passes away prematurely, and also their grandchildren's ability to manage the assets since their grandchildren are relatively young. No surprise here, trusts are the answer for virtually all of these questions. We often see sometimes, parents have a concern with their children's ability to manage assets, whether they've had a spending problem in the past. There's a concern about a spouse. So we often see trusts established for one or more of the children for their lifetime. And these trusts are structured in many different ways. They could involve just income and principal at the discretion of the trustee. They could be what we call a unit trust, which is a percentage of the trust assets being distributed annually. A lot of times we will see that so that there's a guarantee that the child will receive at least a set sum each year. We also see some concerns about, any shares going to grandchildren, that maybe a spouse of your child doesn't manage those and that somebody independently is managing those, with the concern being if that spouse remarries. Is there some affiliation with that second family, and will your grandchildren not be benefited by the money you want them to receive? So we do often see these trusts established for grandchildren to certain ages, as I discussed earlier, the 25, 30, 35 threshold. And then another child being appointed as a trustee as opposed to the spouse or the parent of the children. So now Ryan's going to go through a little bit of some software that we've acquired to do some planning and talk us through that.
All right, thanks, Veronica. Yeah, so this is one of our new financial planning software. And so what the software allows us to do, let me go ahead and start that video. This allows us, so this software basically gives us a great capacity to kind of dictate your personal situation. There are lots of levers, there's lots of variables, so you can kind of customize this plan as complex or as simple as your estate plan is. So as we can see, we have Jim and Susan. They're based off the client scenario we just went over. You can see that they have 3 kids and they have 6 grandkids. And so it lays all of them out. And so you can add, like I said, you can add immediate family, but you can make it as complex as you'd like. So if you have an extended family you want to be included, friends you want to include, that can all be baked in. And then as well as charities. So if you have charities in mind that you want to include as part of your estate plan, we can put those in. And then finally, as regards to wills, we can put in your will, we can put in the exact parameters of the will to kind of help out and map out that asset flow. And so the tree view I found is going to be a great visual representation to kind of show you your overall estate plan, everybody that's included, the net worth of everybody, and kind of how the assets are going to flow. And so first you can see we'll jump to the first death, and it'll show you exactly how the assets are flowing. So Jim has passed away, the assets are flowing to Susan. And then we can also see we've preloaded in 3 different trusts into here. And so now I'll turn on the generic irrevocable trust, and we'll see exactly how that will be mapped out. And so you can see it will update in real time. And so we'll be able to see now that some assets are going to Susan, but some assets are also going into that generic irrevocable trust. And so when we get to the second death, you'll see that the assets from Susan are then flowing to the kids. Now, before we move on, I just want to take a quick break, and I want to discuss the 3 trusts we've preloaded in and kind of when a client might use those. So Veronica, would you be able to walk us through those 3 different trusts and when they may be advantageous?
Yes, thanks, Ryan. So I will start at the bottom here. So the AB trust structure is something we see quite often. This is a marital trust and a credit shelter trust. So these are 2 different trusts, the A and the B. The credit shelter trust is designed to hold whatever the estate tax exemption is in the year that the individual passes away. The nice benefit to that trust being established is whatever goes into that trust is excluded from the individual's estate who has passed away, as well as their surviving spouse's estate. So we're able to kind of double exclude that property, which is nice. And it's the growth too. So if you have someone who passes away early, that growth can be quite dramatic, and it could protect quite a bit of assets. The marital trust is that trust, although exempt on the first spouse's death, is taxable at the second spouse's death. So we generally see more distributions coming from that trust than the credit shelter trust over time. The next trust is the charitable remainder trust. So these can be designed a couple of different ways, but generally how the charitable remainder trust is designed is that an individual or individuals receive a stream of income while they're alive or for a term of years. And then once they pass away, or the term of years expires, the charity that's named receives the funds. You can have multiple charities. It can be going into another charitable trust. You can change charities while you're alive. So there's a lot of flexibility with these trusts. And then the generic irrevocable trust. So that could be anything. As I said earlier, trusts can really be whatever you want them to be, as long as they're drafted in that manner. Sometimes in this situation, you might see life insurance trust, which the life insurance is purchased by the trust in order to replace any estate taxes that might be due when an individual dies, or a trust for a certain length of time for the children.
Perfect. Thanks, Veronica. So we're going to go over it. Now we can see kind of the list view. And so this is, it kind of gives us a good summary of the overall estate, how the various beneficiaries are being paid and the amounts. And then it also, obviously, the most important thing is going to highlight the taxes. And so with any estate planning and tax planning, we're trying to reduce those estate planning taxes in the end. And so kind of that leads us into the next topic, which talks about fairness. And so I'm going to pass it over to Robin, because I know she's had a lot of discussions with around this topic with clients.
Yeah, I'd love to speak to that, Ryan. What's really fun and interesting about our job is as we're working with clients through the process of estate planning, it often comes up, I want to be fair. I want to be fair to my 3 kids. I don't want there to be any conflict after I pass away. And what is so interesting about that discussion is we talk about fair and equitable. Because here's the thing. When you pass away, you usually don't have something that's easily split up into thirds, let's say. It's not always just cash and some stocks and bonds. There's real estate. There's often a family business. There could be a commercial real estate business. There's so many things that make this much more complex. So I'll use a really interesting story that I dealt with, which was really fun to work on because it turned out to be great financial and estate planning. We had a family, and the matriarch had lived in South Africa for years and years, most of her life. And the 3 siblings lived there as well to move back to America. One remained there. So when she passed away, what we did is we had a trust that incorporated both the investment assets, the checking account, all kinds of other things over here, as well as this actual residential real estate in South Africa that they all had wonderful memories of. They wanted to keep it in the family. Well, the one sibling that remained in South Africa, and of course they had talked about this. This was all before she passed away. We had talked with the family to make this exactly customized to them. She got that property in South Africa, and there was enough money from the trust to be sure that she always had enough income to maintain the property because the other siblings would want to visit. But the other siblings got the more liquid assets. There were also less tax repercussions because of the international aspect. So it was wonderful because, again, we got to preserve these wonderful family assets, but every sibling felt taken care of and nobody felt left out, and nothing had to be sold. So there's so many interesting things like we do. And that's, again, why we get so customized and go through these examples and say, well, fair might not mean just dividing everything up. Let's talk about certain assets going to certain parties as it makes sense.
Perfect. Thank you, Robin. Now we discussed the client with $5 million as our example, but now we're just going to touch on a client who's maybe in the upper end with 50 million. Veronica, how would this client kind of view estate planning, and what are some of their concerns?
So this client, this is a similar situation to something we handled for the client about a year ago. The client's married couple have about $50 million. They're concerned about the estate tax exclusion being reduced in 2026. It's going to about half of what it is today. So it was a real concern for these clients. They wanted to do some estate tax planning. They also wanted to, provide for their daughters, protecting the assets in the event of any future divorce. Their daughters were in their 20s and they aren't married, don't have significant others at this point. Also, they wanted to gift in the most tax efficient manner and also have some professional management of the trust assets over generations. One of the things we haven't talked a lot about is, choosing a trustee. And in this circumstance, the clients really wanted a professional trustee because they wanted somebody that could manage the assets over generations. These trusts that were created, there were 2 separate trusts created by each spouse with the amount of their exclusion, their federal estate tax exclusion. They created these trusts for the benefits of their daughters and future generations. The way these trusts are designed, they could go on for hundreds of years, as long as we have assets. So the clients in this situation wanted a professional trustee to be able to manage the assets over those generations. They also built in the ability for an individual family member to be appointed at each successive generation with the corporate trustee in order to allow for some family viewpoints on how to manage the trust. We do see that a lot, and we find that extremely helpful because sometimes there are family situations where we need that guidance as a corporate trustee. We need that guidance and input. And also we're able to be the bad guy. We're able to be the one that, if a co-trustee says, I really don't think my child's, grandchild's, whoever the beneficiary is, I don't think we should make this distribution. I don't think it makes sense. The corporate trustee can be the bad guy and say, okay, as long as it's not completely in conflict with the terms of the trust and it's within our discretion, we can do that. So I think that it's important to think about in naming a trustee who's going to manage the assets over the generations.
And I would break in real quick because there was 2. One was a question that we got in chat, and one was something that we sadly see quite a bit, which is kind of going back to a more complex asset like real estate and trust. And why would you have it in a trust? Because all these beneficiaries are making decisions. No, remember, one trustee. The corporate trustee usually is making the decisions. So you're not having the disagreements, right? Or if Uncle Bob is in charge of the trust and he's only the family trustee, he all of a sudden is in a really awkward position, and family reunions and Thanksgiving is awfully awkward because certain kids are asking for more money than others, and you don't have a corporate trustee either handling everything or balancing it out with him. To help him say, okay, I can be the bad guy and tell this one sibling that no, for this trust to continue for other generations, we need to not send Sarah as much money. And also, sadly, one of the things we see quite a bit where a trustee comes into play is when one of the children has a special need, such as an addiction or a condition, where they need to be treated a little bit differently to take care of them as well as the other members. Veronica, can you give a couple of examples of when you've seen that?
Yeah, I think, unfortunately, the addiction element has become more common over, the last several years. It's a lot of families are experiencing that. So I have seen a lot of documents lately that do allow for that. So they allow the trustee to be able to withhold distributions. So for example, if there was a trust for a beneficiary where they would get a certain principal distribution at a certain age, the trustee has the ability to hold on to that distribution if there is an addiction issue, if there is a spending issue, if they have a real concern. Sometimes with the addiction issues, we see being built into documents that some testing may be required, some verification by a doctor, different things like that. So I think, in any trust documents that are drawn, I think it's extremely important to be very flexible and kind of, I don't like to see everything but the kitchen sink in there, but I do like to see enough to give the trustee some flexibility to be able to meet the grantor's intent, which is the true calling of a trustee, to be able to meet the grantor's intent, but also protect the assets from a beneficiary who may not be able to manage those assets and protect it for them so that once they are able to, they have, a pool of money that they can use for their needs.
Right.
Thanks, Veronica and Robert. Now, we've kind of touched on a $5 million client. We touched on a $50 million client. And obviously, there's lots of customization within your estate plan. So we kind of want to hit on some common strategies to consider when you're thinking about estate planning as well as tax planning. And so kind of the first one we're going to hit on is the annual exclusion gift amount. And so this is the amount that you can give during your life to donees, tax-free and without documentation. Now, this is a per person per donee. So you and a spouse can both give a gift to a child that will help fulfill those needs. And so that's kind of the front end of giving throughout your life. On the back end, we have lifetime gifts. And so that's going to be the amount that you can transfer tax-free at the end of your life. Now we are concerned, and there may be federal changes as with the federal government. We never know what's going to happen. That may sunset in 2025 and jump back down to a smaller number. So that may lead to more need to plan more and kind of give some gifts on the front end as well as plan for the lifetime gift going down. Another strategy we want to highlight is paying college and medical expenses directly. This will not affect your annual exclusion gift amount. So if you have children or grandchildren in college or with certain medical expenses, you can pay those directly and that won't affect your gifting amount. So that's a great way to kind of pay for college or kind of even out gifts throughout a lifetime. And then finally, we wanted to touch on, as Veronica said, there's lots of different types of trusts: grantor trusts, irrevocable, revocable trusts. And so all these trusts have very different, their solutions to different questions or problems you might have.
Right. And the annual exclusion gifts are something that's so easy to do. It's $16,000, per person, per donee. For 2022, it's actually going to go up. One of the few good things about inflation is it will be going up for next year. But this is a fantastic strategy because a lot of people love the idea of leaving an inheritance to kids. But what's really even more valuable to them is learning how to be good custodians of this next generation of wealth. Could you perhaps use an annual exclusion gift to help a child open their first Roth IRA because they've gotten their first job? Right, or their first investment account, or purchase a home, or help them fund college for a grandchild. And this is so rewarding because you're actually seeing them use the inheritance during your lifetime, Not to mention, it's actually going to reduce your estate when you pass away, which is going to save you money on taxes. So it's a wonderful, simple, easy, no documents needed kind of thing that you should really consider doing every year. One thing that I'll throw out too that's really simple and easy is 529s. 529s are still allowing you to front load 5 years worth of that annual exclusion into a plan. And they often have state tax benefits as well. People sometimes even, give money to their kids to then fund a 529. So the children can get a small state tax deduction for that.
Perfect. Thanks, Robin. And one thing I also wanted to bring up was the first two items we looked at here are federal limits. And so there's also state guidelines around estate planning and tax planning. So picking the state that you're going to retire in can have a big impact on estate taxes as well as income taxes. So something to consider when you're thinking about retiring. And next, we kind of wanted to jump directly into kind of charitable giving and that kind of aspect. We know many of our clients are very charitably inclined. And so we wanted to highlight a couple ways that we can optimize that. The first one is going to be with qualified charitable distributions. These can fulfill your RMD requirement for the year, and it allows you to give directly to a charity. And so any amount you donate will also be tax deductible off your taxable income for the year. So it's a great way to satisfy your RMD requirement while still fulfilling that charitable inclination. The next way we see is gifting appreciated stock. The conventional way of doing this might be to sell highly appreciated stock, pay the capital gains taxes, and then send the proceeds to a charity. We found that you can actually donate stocks in kind to charities, and that helps both the charity as well as yourself avoid some of those capital gains taxes. And then finally, as we've kind of alluded to and Veronica touched on, you can establish a charitable trust. There's lots of different versions of that. And so I know, Robin, you've had some experience with this. Would you mind talking about that a little bit?
Yeah, charitable trusts are really fascinating. And before we dive into that, the way I learned about these is actually to picture a fruit tree, like picture an apple tree, right? There's the tree that continues to grow and grow, but every year it has fruit that are harvested, right? So the tree is the corpus or the body, the principle, and the apples, think about those as the income. Right. So there's two different main kinds of charitable trust. We alluded to one earlier in the presentation. And what this allows you to do is either choose a term of limits and the income, the apples, go to that favorite charity or charities during that term. And at the end, the corpus goes back to the family and the beneficiaries, or the opposite. A lot of people will set these up and they're getting for a set number of years the income, the apples from the investment, and then at the end the body, the corpus, goes to the charity. Different tax repercussions for each, different needs. There's reasons you might do both. In a rising interest rate environment, some get more appealing than others depending on the situation. The other neat thing about this is it again is establishing a family legacy of charitable gifting. And it also comes in very handy for those of you who mentioned to me that they don't have children. And they don't have heirs, and they're thinking of doing something that takes care of them. Because remember, you're not giving it all to charity. These types of trusts are actually designed to benefit both the grantor and the charity. So they're really fantastic, especially when you're in a situation like that where you're either trying to teach the family more about charitable gifting, or you might not have individual family members but can do a great deal of good to multiple charities through this structure. One other thing I was going to mention real quick, going back to gifting appreciated stock, you will often see people put appreciated stock in a charitable trust. The trust sells it and then diversifies the assets. And there's a better tax repercussion from that. And again, qualified charitable distributions. I know you all get sick of me talking about it. I talk to all my clients that are over 70 and a half. Don't forget that even though the RMD age is now 72, once you turn 70 and a half, you can go ahead and start making up to $100,000 from an IRA directly to a charity. Remember, that's very important. It doesn't go to you, it goes directly to the charity, and that is not counted as income. So it's really fantastic, as a lot of custodians even have little checkbooks from your IRA where you can send it directly to the charity, much as you would just send a check to your church or the Boy Scouts or whatever means most important. Or we have people contact us and say, send this donation directly from my IRA to so-and-so at this charity. We take care of all of that for you. And it's a wonderful, wonderful benefit that saves taxes and helps your favorite charity. Again, that's why we look at tax returns quite a bit. We could save you possibly money on charity and give as much or more to the charity in future years with this planning.
Perfect. Well, thank you so much, Veronica and Robin, for your time. Now we wanted to kind of move in to the Q&A portion, and we received a number of great pre-submitted questions. And so the first one I wanted to, a client was talking about the best method for an adult child to help aging parents pay bills. And they specifically mentioned a springing power of attorney. So I wanted to pass it over to Veronica to kind of explain that one.
Sure. So powers of attorney come in a few different flavors. You have a durable power of attorney, you have a non-durable, and a springing. A durable power of attorney is a power of attorney that's signed. It's effective immediately upon signing. Some people don't feel comfortable with that. They don't, because literally the person you name could go to the bank and clear out your bank account because they're named in that document. What some people do is the springing power of attorney, which spring, as the term says, springs into effect when a certain condition is met. Usually that condition is a finding of incapacity. And the document will usually will direct what that finding involves. Does it involve 2 doctors? Does it involve 1 doctor? Who makes that determination? And once that determination is made, then the power of attorney has power to act. I am not the biggest fan of springing powers of attorney just because they can delay the ability of your agent to be able to access your accounts. For example, you have a document that says, I need a note from my doctor saying that I'm incapacitated, unable to manage my affairs. Your power of attorney has to go to the doctor. The doctor has to agree to sign a letter saying that you're unable to manage your financial affairs. I think doctors have become more agreeable to signing those. Historically, many years ago, that wasn't the case. So I think that they've become more agreeable to that. But then you have to provide that letter to whoever your whatever financial institution you're dealing with. So it's another layer in the process. As long as the parents feel comfortable with signing the document and having the power of attorney be ready to act right away, I don't see a need for a springing power of attorney.
Thank you. And Robert, I'm going to pass the next question off to you. We received a number of questions around the top 5 or top 3 estate planning tax guidelines. So what would you recommend as kind of the top items to keep in mind?
Well, really, that's why we like to look at everybody's situation individually, because depending on that, it might make sense to do one versus the other. And you really want to involve your accountant. Usually your financial advisor will love to see a copy of your tax return, or especially the charitable section, because that can be huge, as we talked about earlier with saving taxes. And just see, are there other deductions? Is there other planning that we can do to save you money, whether it's at death or during your lifetime? Because again, tax rules are continuing to change and evolve, or some people would say devolve, as the case may be. And so we want to keep up with all of that and make sure, honestly, this year with the market and the things we have been, one thing I've been telling a lot of clients is, gosh, if we can't make you as much in the stock market this year because it's just a bad economic situation, let me save you some thousands of dollars because of your estate and tax planning. That's definitely something we can do and save some money there.
Perfect. Thank you. Yeah, and I think Robin and Veronica would agree with me that being proactive is the best approach with estate planning. And Veronica, I want to pass the last question off to you. We received a great question about special needs estate planning. I know we touched on that a bit, but I wonder if you could talk to that a little bit more.
Sure. So there are particular trusts that are established for individuals with special needs. Those individuals are those defined by statute as disabled under the law, and are eligible for generally, Medicaid and other government type benefits. So there are specific trusts that can be designed for those individuals, and those trusts will allow the money in the trust to be protected and not have to be used to pay for the care of the individual, and be used to supplement. In New York, we call them supplemental needs trusts, because the trusts do supplement the needs of the disabled beneficiary. I have seen these types of trusts used for family trips, for purchasing the computer, a gaming system, housing. Sometimes people want a house or modifying a home, such as putting in a wheelchair ramp, or establishing the shower so that it's accessible by an individual who's disabled. So I think that there's a lot of different reasons to use these trusts. And if you do have a beneficiary who does have special needs, it's highly recommended that you do this type of planning to ensure that they can qualify for the government benefits available to them.
Perfect. Thank you so much, Veronica. And so we want to be cognizant of time, and so that's all the time that we had today. But if we didn't get a chance to answer your question live, there will be a personal follow-up. So we'll make sure that all the questions you guys have asked today will be addressed. I wanted to thank you all for joining us today. I hope you guys learned a lot. And if you're interested in any of these strategies, you can click the link you see on the screen to schedule a call with one of our reps, or if you were currently working with a financial consultant, they're very familiar with all of these and they can kind of discuss many of these estate planning strategies and tips and kind of find out what works for you and what could be applicable in your situation. If you're also interested in learning more about the services we offer, you can contact Manning & Napier. We produce a great range of content around financial planning, family wealth management, tax planning, inflation. So feel free to subscribe to that and that'll get sent directly to you. And then finally, a recording of this webinar will be available shortly after in case you weren't able to catch all of it live. And so once again, on behalf of my colleagues in Manning & Napier, I wanted to thank you for your time and hope you guys enjoyed it. Thank you.